Hello everyone, Thayne here, Director of Financial Planning, providing you with an update. So last week we caught up with our research team from Sydney for an investment committee meeting just to analyse our investment portfolios, how everything's performing, the latest economic impacts as a result of the cost of living and inflation and the expectation of interest rates increasing, and obviously the war within Ukraine. So Europe are going to end up with a lot of refugees moving from Ukraine and Russia, so that'll be an economic burden on that economy or part of the world. Oil and gas prices along with wheat and fertiliser have increased substantially as well, given that there is the embargoes on Russia. So it means that they have to source these goods from elsewhere. So roughly 60% of oil and gas exports do come from Russia. So given that there have been the embargoes on Russia, they do have to find these goods elsewhere. So overall, we're still exposed to variable interest rates, given that there is the expectation of interest rates continuing to increase, and wanting to make sure that we're investing in companies where if input costs are increasing, so such as fuel, fertilisers, etc., that they can pass these input cost increases on to the end consumer, so companies can maintain their profit margins in order to be able to maintain dividends, which will invariably maintain share prices. Last week we sent out an email regarding private health insurance. So it's this time of year, every year, where private health providers review their premiums and potentially look to increase them. If you'd like to do a review of your private health insurance, please contact us, as we have the capacity to do this internally. We could also incorporate it in with a personal insurance review, so reviewing life insurance, total permanent disability cover, trauma insurance and income protection cover. Given that we are fast approaching the 30th of June, I encourage those to start thinking about if they're going to make any additional contributions to superannuation, which they can claim a tax deduction for. Especially those clients where their superannuation balances are just shy of 500,000 and likely to exceed 500,000 in the next financial year, as this will be the last financial year to be able to use the unused contribution limits. If you want to learn more about this, please talk to one of our advisors. Other superannuation contributions that you might want to look at or consider are the government co-contribution, where if contributing up to $1,000 to superannuation, you may be eligible up to $500. There's also spouse contributions, so depending on what your partner earns in comparison to yourself, you might be eligible for a $540 tax offset. There's also superannuation splitting, where it's possible for husband and wife, where there's a bit of an age gap, to transfer superannuation contributions each and every financial year to the eldest member, so that they can access the superannuation sooner and earlier than they otherwise would. And there's also tax-free contributions as well. If you're wanting to get lump sum amounts into superannuation where you don't have to worry about capital gains tax or paying tax on investment earnings, and then also have the ability to access the money back again tax-free, once again, talk to one of our advisors and we'll be able to give you the specific advice relevant to your needs. So thanks for tuning in. Hopefully there's some valuable information there for you. Once again, if you'd like us to go through and work through this and relate it to your personal situation, please feel free to call the office or contact us at info@mulcahy.com.au to organise a time. Thank you.